So continuing with the discussion in chapter 14, what we're going to move on to now is going through some examples. So now that we have an understanding of sort of generally what a bond is and the different attributes that we need to look for in each of the problems to sort of get an understanding of all of the ins and outs of that bond, now we can start to work through some of these example problems. So the first example that we're going to go through, we're actually going to look at it from the perspective of both the company issuing the bond as well as the company or individual who would be investing in that bond. So throughout the majority of the rest of the examples, we'll probably just focus on the company issuing the bond, so the company that has the bond liability. But again, for this first example, we're going to talk about both. Okay, so January 1, we have a company that issued $700,000 of 12% bonds. So 12% is our stated rate of interest. So we can start by kind of labeling these items as we walk our way through it. So that's our stated rate. That's what we're going to use to calculate the payment that is owed. $700,000, that's the face amount. So that's our future value. And then it says that they actually do the calculation of interest for us. It says that the interest is paid semi-annually for $42,000. So the way that we would get that, that's the payment amount. The way that we would get that is by taking $700,000 times 12% times 6/12. Again, because this is semi-annual interest, we would have to take that annual 12% interest rate stated in the problem and divide it by 2. Or multiply by 6/12 in order to get it to be a 6-month interest rate. So again, interest paid semi-annually June 30th and December 31st. The bonds mature in 10 years. So that's our maturity period. But we know that in order to figure out the number of periods that we would use in our equation, we would take that and multiply it by multiply it by 2. And that's our number of periods. The reason why we have to do that, again, is because we have to account for not only the maturity period, but also how many times interest is expected to be paid over the given period of time. So our number of periods would be 20. The entire bond was sold in a private placement to United Group at the face amount. So here is the key component to this particular example. This bond was sold at its face amount, which we already said the face amount is the $700,000 that's given to us in the problem. So in this instance, because the bond is being sold at the face amount, what we are going to be saying is that the stated amount of that bond, $700,000, is how much that bond is worth when we actually go to sell it on January 1st or issue it on January 1st, 2021. So in this particular problem, we actually don't even need to do any present value calculations. We simply need to say that the bond is sold at its face amount, meaning the amount of cash that's received on day 1 on January 1st, 2021 is the face amount of those bonds in total. So if we go over to our Excel spreadsheet, in our first tab, it just says very simply bonds. It's labeled. We're going to focus first on the issuing company. So what would be the journal entries that the issuing company would have to report on the day that they issue the bonds, as well as the periodic interest payment dates. So you can see again at the top of our Excel spreadsheet all of our information. Notice the calculation of interest payments. So again, we take the face amount times the stated interest rate and we divide that by 2 because these are semi-annual interest periods. Our maturity period is 10 years, and we know that that means that it's 20 periods because interest is due semi-annually. So 20 periods is taking into consideration those interest payments. Okay, so on January 1st, we very simply, as the issuing company, would show the receipt of cash, so a debit to cash of $700,000, because again, we said that these bonds were issued at their face amount, $700,000, and then we would have a bond payable, which is our bond liability, as a credit of $700,000. So very simple journal entry where we debit cash, credit bond payable. When it gets to the point on June 30th where we have to make our first interest payment, the issuing company would debit interest expense for that first payment of $42,000, and again that was already calculated by taking $700,000 times 12% divided by 2, and we would credit cash, And then we would actually do that exact same thing for December 31st as well. Very simply, we would debit interest expense and credit cash. Interest expense for $42,000 debit, cash for $42,000 credit. So again, this is an instance where our bond is being issued at its face amount. So we're not doing any present value calculations yet. We're just accounting for this bond at its face amount. So then thinking about this in terms of the investor's point of view. So if I kind of minimize my screen here, because what we want to look at is almost as a mirror effect from the issuing company to the investing company, how these journal entries sort of relate to one another. So if we look at our issuing company, they received cash on day one. That would mean that the investing company would be paying cash on day one. So that investing company would have a credit to cash of $700,000 on January 1st. And if the issuing company had a bond payable that they reported on their accounting records, then the investing company would have a bond receivable that they would report on their accounting records on that first day of $700,000. So you can see how they're sort of mirror images of each other, right? One is receiving cash, one is paying cash. One has a liability, the other has an asset. The same thing is going to go for the journal entries on June 30th and December 31st. If the issuing company has cash that is being paid out, well, then the investing company has cash that's going to be received. So they're going to have incoming cash, a debit to cash of $42,000. And I'll just do that again for December 31st as well. Cash in, cash in is a debit of $42,000. And then if we look at the issuing company on June 30th and December 31st, they reported interest expense. So what you're going to see on the investing company's accounting records is going to be interest revenue. So one is incurring an expense, interest revenue, which means the other is sort of earning the interest income or the interest revenue. And so that's the very simple set of journal entries that we would have to record when a bond is being sold at its face amount, and then we had periodic interest payments over the first year's worth of time. And obviously these periodic interest payments would then happen every 6 months over the entire 10-year period. So now, let's think a little bit more about sort of the fact that this bond was issued at its face amount. So what we said was the bond was issued at the exact amount that that is stated in the bond contract, $700,000. Let's think about this question for a second. Why would a bond be sold for more or less than the face amount? Right? The answer to that question is going to be really focused on the stated interest rate of our bond versus the market interest rate that's going out in the bond market. Okay, so let's think about that for a second. Our stated rate is what's going to be listed in our bond contract as the amount that we intend to pay periodically to our investors. That could potentially be different than the market rate. Okay, the market rate as we talk about these bonds, the market rate we can think about as basically on average out in the marketplace. If we looked at organizations that look just like ours, they're about the same size, they have about the same amount of risk, what are they offering for their bonds out in the market on average? Again, thinking about sort of the entirety of the bond market for companies that look like us, that have bonds that are similar to ours, that have a similar risk assessment as our company, what on average are those bonds going for? What on average are those bonds offering in terms of an interest rate? Now, there may be differences between what we are offering, the stated rate, and what on average everybody else out in the market that looks like us, what they're offering, the market rate. When we have differences between the stated interest rate and the market interest rate, that is where we may see examples where our bond is sold for either a little bit more or a little bit less than that face amount. Okay, so again, you can see in the example that we had, the stated rate and the market rate was essentially the same. That means that our bond was sold at its face amount. The amount of cash that we received on January 1st was the face amount of that bond, $700,000. But what happens if our interest rate is 12% and everybody else out in the market that looks just like us, that's offering bonds, they're all offering on average 14%. What would have to happen to the price of our bonds in order for us to be competitive is that we would have to offer our bonds at a discount. Our bonds would be worth on day one a little bit less because we're offering 12%. Everybody else out in the market in comparison to us is offering 14%. What investor in their right mind would invest in our bonds when they can go out in the market and get on average 14% and we're only offering 12%? What we have to do is offer those investors a discounted price. So on day one, we would not receive $700,000 in cash. We are going to receive less than that. And then vice versa. What if our bond is offering 12% and everybody else out in the market on average is offering 10%? We then would be sitting in an advantageous situation. Our bond is offering a higher interest rate to those investors than the majority of the market, which is only offering on average 10%. That means we would be able to issue our bonds at a premium price. We would actually be able to issue those bonds for more than $700,000 because our interest rate is more than what's going on in the market. We're offering a better interest rate, which means we can charge those we can charge those investors a premium on the bonds that we are selling. Now, finally, why would there be differences in the interest rates, right? Why wouldn't we just set our interest rate at the same as what the market is? Why wouldn't we, attempt to do that? Well, in reality, companies will try to set their bond rates at what's going on in the market. But oftentimes there is a time gap between the time that we choose the stated rate that we want for our bond and the time that those bonds actually get issued out in the market. There's oftentimes a lapse in when we pick our stated rate and when the bonds are actually issued in the market. Because there's the time lapse, right? We know that market rates fluctuate over time. So we may see a change in that market rate unintentionally, right? We intended to be in line with the market, but because over time the rates have fluctuated, now our stated rate is different than what's going on in the marketplace. Okay, that is what is going to be the cause of some of these discounts and premiums that we'll see in the pricings of our bonds. So the last thing that I want to mention is when we in the next video start going through the calculations where we have to calculate the value of our bonds given these different rates, what we want to keep in mind, and what we mentioned already in a previous video, is that the stated rate is what we are going to be using to calculate our payment. So interest payment is used, the stated rate is used to calculate the interest payment. The market rate is what we are going to use as the rate in our present value formula. So when the formula asks for a rate, they're asking us for this market rate of interest. When the formula asks us for our PMT, our interest payment, that is when we use the stated rate of interest.